Hey guys, this video I'm going to show you how you can use the wheel strategy to lower the cost of the stock that you are bullish in the long run. Selling covered calls or selling cash secure puts is the ideal strategy for investors who would like to own a underlying security for the long term and doesn't mind owning the shares and holding on to it for a long time. So how does this strategy help you lower your costs? So I'm going to take a real life example of a security that I traded recently and show you how it can lower your cost average over time. So a while back, I sold a Fastly cash secure put for $80 premium. So this $80 premium will always be in my account no matter what. I get this money right away in my account. I get to use it however I want. So when I sold this cash secure puts, for those of you who don't know what cash secure puts is, a cash secure puts is when you are on the selling side of an option. So when you sell an option, you have to put up the money for 100 shares of the security. And in my case, it's 83.5 times 100, which is $8,350. That money will be locked up in your broker. In return, you get $80 instantly in cash. Now, by the time this option expires, if Fastly goes above or stays above 83.5, you will pocket this money no matter what, and the $8,350 will be returned to you. So you make a pure profit of $80. Now that's one scenario. So you can just keep doing that for a long time and then keep pocketing the premium. Now, if you are long, like for me, I understand Fastly really well, and I think this company will do really well in the future. So I don't mind holding on to 100 shares of Fastly if I get assigned. So what does it mean when you get assigned? So in my case, I actually did get assigned. So when this option expired, Fastly's price was lower than 83.5. So I was forced to buy 100 shares of Fastly at 83.5, meaning I got assigned Fastly, and then here is when I was forced to buy 100 shares with the money that was locked up earlier. My broker will automatically buy me 100 shares of Fastly at 83.5. Now I have 100 shares of Fastly that cost me $8,350. So now I am nothing more. I'm no different than a stockholder who holds 100 shares of a security. So what can I do in this case? Well, I can turn around and sell a covered call for it at the same strike. So what does that mean? That means I'm selling an option. I'm selling a call option that will expire in 4 days for the same price of 83.5. So this means if Fastly goes above 83.5 by expiration, I will be forced to sell my Fastly shares, 100 shares for 83.5 each. That means I will return $8,350 to my bank account. So that means I'm break even. I don't have to do anything. I'm broke even, and then I still keep the $80 that I had before. However, when I sell this call here, I pocketed $215 instantly from the premium of the call option. So the premium, this money goes to my account no matter what at the end of the week. So when that happens, if Fastly goes above it, then my 100 shares get called away, and then I pocket this, and then my sum total profit will be $215 plus 80, which is $295. That's for me to keep, and I don't have any risk. I didn't lose any money on the 100 shares. However, if this covered call did not get executed at the end, so if Fastly stays below 83.5 by the expiration of this call, then I will keep the whole premium no matter what. So I still have $295. However, now the price of Fastly, let's say Fastly, well, today it dropped tremendously to 76.87. Now, if you do the math, if I have 100 shares of Fastly, so when this expires worthless, I still have my 100 shares of Fastly that I'm still in my bank account, right? So right now I own 100 shares of Fastly at 83.5. But if you look at Fastly right now, it's at 76.87. So that's about $700 difference from my buy-in price. So I'm actually down $700 on Fastly because Fastly dropped. So every dollar it drops, that's $100 that I lose. Now, you would say, hey, why would you do this? This is pretty risky. You're right, it is risky. That's the risk of an option seller, is that you don't know the underlying security. You lose big when the underlying security drops big. In Fastly's case, it drops pretty big. But I know Fastly, and this is pretty much its regular movements daily. It could go up this much just as fast. So, however, the beauty of this strategy is that now I have 100 shares at 83.5, but that's not really the truth, because I actually pocketed, remember, I pocketed $295 in premium. Let's round this up to $300. So $300 is in my pocket right now. So instead of losing 600 right now, or 700, I'm actually losing only 400 because I have this $300 premium that I can offset against that. So in reality, the cost average of my Fastly shares is about 80.5. It's not exactly 83.5 because I have these $300 here to offset that. So that's the beauty of this thing, is that I can keep selling my cover call next week, the week after, or 3 weeks out, and then just pocket huge premiums for it. And over time, this will lower my cost average of Fastly shares. So that's the beauty of this strategy, and I can just keep doing this forever. I've heard people who done it for like a year or two, and they got their cost basis to $0. So pretty much they pocketed like $8,000 in premium, and then in the end they own 100 shares of Fastly for free. Now this is a strategy that I can go with. So one key thing is that you have to do this with a stock that you are comfortable owning a long time, for a long term. And then the company probably should need to have good fundamentals. So you have to understand what the company does, their EPS, the PE ratio, and you have to look at their long-term charts to see, if you are bullish or not. Always read, the ratings and stuff. So that's my recommendation to you, and that is what this video is about, to show you the power of the wheel strategy and how you can use it to, lower your minimum, your average cost. And that's it for this video, and I hope you guys enjoyed and learned something from this video. Make sure to like and subscribe to my channel, and I'll see you guys next time.